Okay, good morning to all students. This session is especially on cost and FM, means cost and management accounting and financial management, suggested answers relating to your recent examination held in the month of July. Actually, exams were scheduled in June, but due to some reason it was postponed and conducted in July. So this is recent July examination paper suggested answers. So this video is prepared in two parts. First part is related to your section A, means part 1, that is MCQs, fill in the blanks, match the following, true false. Second part of the video will be on descriptive long answer questions, including theory question answer discussion. So students have to watch this session for understanding what means they have done in the examination in MCQs, fill in the blanks, match the following, and true false. Okay, so without wasting the time, we'll start. And the solutions which I am providing here is 100% authentic. You can 100% means consider that this is correct without any error. Only in one or two places one small assumption is possible. So because of that, my answer and institute answer can differ. Only in one or two places. 99% answers are 100%, means out of 100%, 99% is perfect answer. I can say 99.99% also. So after watching this video, please subscribe and also like the videos so that we can prepare more number of videos. And if you are subscribing to our channel, definitely whenever we are providing the new videos or uploading the new videos, you will get the notification. So without wasting time, we'll start now. So your paper is cost and management accounting and financial management. This is your paper. Okay. So this paper is consisting of two parts. One is cost and management accounting and second is financial management. So first we are discussing about part A, that is cost and management accounting. In this we are discussing about section 1. So first question number 1. This question is on MCQs. Choose the correct answer. So first question, X Limited provides you with following information. Particulars are given: April to 30 June, 1st July to 31st March. So they have given sales, they have given total cost. So when students see this question, they will think, sir, this is a marginal costing, CVP analysis question, change in profit by change in sale question. Yes, question is on change in profit by change in sale. There is no doubt in that. But try to understand the data. In marginal costing, when we discuss about PV ratio calculation by using change in profit by change in sale, either 1 year data will be given for previous year and current year, or 2 different years, or 6 months data will be given. But in this question, first time institute has made the changes. So in one of the data they have given 3 months duration and 3 months information, and in one they have given 9 months information. So they have not given 6 months, 6 months. One is 3 months, another is 9 months. So that has been changed. So this is the new change. So this is a 3 months data. This is a 9 months data. So sales at the rate of 100 per unit, 10 lakhs, 35 lakhs. Total cost is 3 lakh 90,000 and 13 lakh 20,000. So we have to calculate total cost. So very simple. Okay, we have to calculate the total cost. So generally total cost is nothing but what? Variable cost and fixed cost. Total cost is nothing but what? Variable cost and fixed cost. So variable cost is the cost which will vary according to output. So first we have to calculate the units here. The units for first 3 months. So units for first 3 months will be 10 lakh divided by 100. 10 lakhs divided by 100. This will be 10,000. And next 9 months period, this is 35 lakhs divided by 100, because sales is 10 lakhs and 35 lakhs and per unit selling price is 100. So we are dividing with 100. This is 35,000. So this is your units. Now variable cost is, and you have to calculate on this, 10,000 into variable cost and 35,000 into variable cost. So we are assuming variable cost as X, fixed cost as Y. You have to frame one equation here. Now you can see the answer. Focus. This is July 23, part 1, section 1. So total cost, fixed, variable cost and fixed cost. So variable cost is what? Units into cost per unit. So fixed cost is periodic, so not relating to volume. So number of units you have to calculate from April to 30 June means 3 months. This will be sales divided by 100 rupees selling price per unit, 10,000. And next will be 9 months, 1st July to 31st March. This is 35 lakhs by 100, 35,000. So 10,000 units, 35,000 units. Now April to June, your variable cost is 10,000 into X. We are considering variable cost per unit as X. So variable cost per unit is X. So 10,000 into X. So July to March, 35,000 into X, 35,000 X. Now fixed cost will be considered as what? Y. So fixed cost is monthly. So 3 months into Y in first, 9 months into Y in second. So total cost will be 10,000 X plus 3Y. Here 35,000 X plus 9Y. And already total cost is given in the question. April to June 3,90,000 given, and July to March 13,20,000 is given. So 10,000 X plus 3Y will be equals to 3,90,000, and 35,000 X plus 9Y equals to 13,20,000. Now we have to solve this. So when you solve this, you will get X variable cost per unit 30 rupees, okay, and Y fixed cost per month is 30,000 rupees. So fixed cost per month is 30,000. So per month 30,000. You have to calculate the fixed cost for 1 year. So it will be 30,000 into 12, 3,60,000. So your answer will be B. So students have to answer or select B here. So your first answer is B. Your first answer is B. This is the correct answer. I hope students have understand this. Now we'll start the next question. So this question on budgetary control. This question is on budgetary control. Budgetary control, production budget. So in production budget, already students know how to calculate the production. Production will be equals to, production is calculated from sale plus closing stock minus opening stock. So sales of finished goods plus closing stock of finished goods minus opening stock of finished goods. So here we have to calculate the budgeted production. So budgeted sales units plus closing stock units minus opening stock units, you will get production. So this is very simple, yes sir. But from past previous attempt onwards, institute is generally testing one area, that is what? Wastage. It means from sales plus closing stock minus opening stock, we will get production, but this production is a net production. It means from this already wastages have been removed. So we have to calculate before wastage what is the production, or before rejection what is the production. Because whatever units you produce, it is not guaranteed that is 100% means defect free. Sometimes there is a small defect also possible. So wastage also possible. So that will be separated. So before that, what is the production we have to calculate. So in nothing but gross production. We have to calculate gross production. So gross production is nothing but net production into 100 divided by 100 minus your rejection rate. Rejection rate. Okay. So first we have to calculate your budgeted sales already given. So net production we have to find out. What we have to find out? Net production. So net production is sales plus closing stock minus opening stock. Okay. So sales plus closing stock minus opening stock. So sales already given 8,000 here, and closing stock of finished goods 2,700. Now opening stock quantity is not given, 20,000 rupees given, per unit given. So this is 20,000 divided by 20 rupees. So this is 1,000 units. So net production will be what? Very simple, 8,000 plus 2,700 closing stock minus opening stock 1,000. So this will be 9,700 coming. How much coming? 9,700. So net production is coming 9,700. So 9,700 is net production. So we have to convert this into gross. So very simple. So 9,700 into 100 divided by 100 minus, what is the rejection rate? 3%. It means 9,700 into 100 by 97. So we'll get 10,000. So this answer is 10,000. Understand? The solution is already available. So I will explain once again. So concentrate. Clear? So first we have to find out net production. Thereafter net production is converted to gross before rejection. So answer is B here again. Answer is B. See this. The budgeted production is equal to budgeted sales plus closing stock of finished goods minus opening stock of finished goods. Budgeted sales 8,000 units, closing stock 2,700 units already given. Now opening stock 20,000 rupees given at the rate of 20. So 20,000 divided by 20. Okay. So your budgeted production is 9,700. Clear? Now gross production or before rejection, the production will be 9,700 divided by 1 minus rejection rate. So 1 minus 3%, so 97%. So 9,700 by 97%, 10,000 units is your answer. So answer is B. Answer is what? B. Now students will have one doubt. This is FIFO method. FIFO method will not affect your answer here because previous year units anyhow will forward to the next year. Okay. So this will not affecting your answer because this is previous year closing stock. This year it will be opening stock. That's it. Now next question. I hope this is understand. Yes, sir. Now question number 3. So question number 3 will be on standard costing, material variance. So this time question is not very simple. So they have given some different information. This type of question is already we covered in direct material chapter in stock levels. Okay. So budgetary control question also already it is covered. Clear? So material variance is a standard costing. You have to analyze here. So in material variances, cost variance, price variance, usage variance. No? So examiner has tested the question from that. Clear? But question is not given in a straightforward way. So he has testing the algebraic knowledge of the students, max algebra knowledge of the students here. So here we have to frame two equations. Clear? So they have given the difference between standard quantity and actual quantity. They have given the difference between standard quantity and actual quantity. And he has given the hint about standard quantity, actual quantity, total. So from these two equations, we have to find out the required usage variance. See, average of actual price per kilogram of material and standard price is 22. So average price means what? Standard quantity price plus actual price by 2. Standard price plus actual price by 2. This is average price. This is 22.5. So it means standard price plus actual price is how much? 45. Standard price and actual price is how much? 45. Clear? Now difference between standard quantity of material and actual quantity of material is 16. So standard quantity and actual quantity difference. This is given as 16. Okay. An average of standard quantity of material and actual quantity of material. The standard quantity of material, actual quantity of material average means standard quantity plus actual quantity by 2. This is 52 given. The standard quantity plus actual quantity will be 104. So first we have to calculate these three inputs. One is standard price, actual price. Okay. Yes, sir. Was average of actual and standard given. Then difference between standard actual given, difference means minus 16. And again average of standard quantity and actual quantity given. So this is standard quantity, actual quantity, average 52. So standard actual 104. Clear? Now we have to calculate material usage variance. So material usage variance formula is what? Material usage variance formula is what? Standard quantity minus actual quantity into standard price or actual price. Standard quantity minus actual quantity into standard price. Okay. Now already I solved the question. Check. Why here space is not properly available? Check. So difference of standard quantity and actual quantity. Clear? Difference of standard quantity, actual quantity. This is 16. This is x minus y. Average of standard quantity and actual quantity. So this is SQ plus AQ by 2, 52. So when we multiply 52 into 2, 104. So this is x plus y, 104. So x plus y, 104, x minus y, 16. So y cancelled here. X plus x to x, 104 plus 16, 120. So x value is 120 by 2, 60. It means standard quantity is 60. The actual quantity is 104 minus 60, 44. Now price. Actual price plus standard price by 2, 22.5. So x plus y is 45. Now material cost variance. Material cost variance formula is what? Standard quantity into standard price, actual quantity into actual price. So this is 100 favorable given. 100 favorable given. So we'll use this. Okay. 100 favorable given. So standard quantity 60, standard price we don't know. Actual quantity 44, actual price we don't know. So this is 60x minus 44y equals to 100. This is second equation. First equation is x plus y equals to 45. Second equation is 60x plus 44y equals to 100. Now we have to multiply the second equation with either 60 or 44 to cancel one variable. So I am multiplying with 60 to cancel x. Okay. After that the equation is 60x plus 60y, 2700. Now 60x plus 60x minus 44y, 100. Now xx minus cancelled हो गया. So 60y 44y difference is, add, because minus of minus plus. So 60 plus 44, 104. And this is 2700 minus 100, 2600. So y will be 25 rupees. The actual price is 25. Actual price is 25. So total of actual and standard is 45. Actual is 25. So standard price will be 20. That's it. Now you can substitute it here. Standard quantity minus actual quantity into standard price. Standard quantity 60. Actual quantity 44. Standard price 20. So 320 coming. So favorable coming. So answer is A. Answer is A. I hope this is understand. Yes, sir. So answer for this question is A. If students want these solutions of complete question paper, they have to subscribe our channel and they have to call the admin person. It will be sent to the students by WhatsApp or their mail IDs. Okay, if they want the full solutions, detail. This is detailed solution. Everything is clearly explained. Now next question. Question number 4. So question number 3 also we already covered in our classes. Now calculate the efficiency ratio if capacity and activity ratios are 96%, 90.25%. In this entire paper, this is the only simple question which we can solve directly. Remaining all questions, some tick is given. This is the only question where the student can solve directly. So activity ratio. So when we learn overhead variances, in overhead variances, especially fixed overhead variances. In fixed overhead variances, we have different types of variances: cost variance, expenditure variance, volume variance. So volume variance is break up into capacity variance, calendar variance, okay, and your efficiency variance. So volume variance is if this overhead variances, that is fixed overhead variances, if management want to understand the performance of these variances through ratios, that will be called as control ratios. That is nothing but you are analyzing the variances through ratios. So activity ratio is nothing but volume variance. So this is volume. This is what? Volume. So in overhead variances, you know ki fixed overhead volume variance will be equals to fixed overhead efficiency variance and fixed overhead capacity variance. So fixed overhead capacity variance, fixed overhead efficiency variance. So already they have given efficiency ratio, calculate the efficiency ratio. This we have to calculate. So if capacity and activity ratios are 96%, so this is activity, volume variance is activity. So through this we have to calculate. Okay, so very simple. So in variance analysis, this will be plus. Okay, now in control ratios, this will be what? See, in control ratios, your activity ratio is equals to what? Capacity into efficiency. Capacity into efficiency. So activity ratio is how much? 90.24%. Capacity ratio is 96%. Efficiency question mark X. Now you can find the X value. Okay. So 90.24 divided by 96%. Clear? So 90.24 divided by 96. So 94% coming. So 94%. So your answer is 94%. Clear? So check this. And answer is 94. So answer is B. Answer is what? B. So activity ratio or volume ratio. See, in books they will not use volume word, but for simplification purpose, in our class we discuss this as volume, because volume variance is equals to capacity, calendar and efficiency. So capacity ratio is 90.25. Efficiency ratio we have to find out. Activity volume variance ratio is already given 96%. X will be 90.24 by 96, 94%. Answer is B. Chaliye, so answer is B. Understand? Yes sir. Perfectly understand. See, question paper is tougher, easier, that I will discuss in last. Right now we are focusing on what? Answers. In starting, we will not discuss about that. In last, I will explain what was the actually scenario. Next question is fifth question. This is a concept question on CVP analysis. In CVP analysis, we understand margin of safety, break-even point, PV ratio, angle of incidence. Angle of incidence we understand on graph. Okay, angle of incidence means when we prepare the graph. In graph, generally revenue cost in one revenue and cost will be matched at one particular point, that is a break-even point. So after break-even point. Above the break-even point, one angle is created. So that angle is called as angle of incidence. If the shape of that angle is generally big, it represents profit margin is high. If that is small or narrow, it represents lower profit margin. Very simple. And total sales will be equals to your break-even sale and margin of safety. This also you know. So if break-even sale is less, margin of safety will be more. If margin of safety is less, break-even point will be more. If you have the concept of these two areas, you can solve this question easily. Yes, sir. So break-even point is low, so it means margin of safety will be high. So where margin of safety high point is given? C and D. So from these two, one answer is possible. But wait, an angle of incidence is small. Angle of incidence is small means profitability will be low. So your answer is D. So margin of safety will be large and rate of profit will be low, because angle of incidence wider, broader means high profit, small or narrow means low profit. So answer is D. So answer is D. Check, this is angle of incidence. On chart we will prepare break even means calculation in this way. So here one angle will come. So this angle is called as angle of incidence. If this is small, profitability will be less. If this is large, this angle large means profitability will be high. So total sales, break-even sale and margin of safety. For example, if total sale is 100, break-even 20, so margin of safety will be 80. If total sale is 100, break-even point 80 means margin of safety will be 20. The examiner has tested this question. It means break-even point is less, so margin of safety will be high. And the angle of incidence representing small angle means profitability will be low. So if angle of incidence is small, it represents low rate of profitability. So your answer is D. Answer is what? D. I hope this is also understand. Yes, sir. This is already we understand and we discuss in classes. Okay. I hope the students have properly given the answer, correctly given the answer. So we'll start now. Next question. Next question is already previous question number 2. You already understand production budget. So production budget, what is production? Budgeted production, sir, sales plus closing stock minus opening stock. This is a free question, bonus question. In this question, students can easily answer. Yes, sir. Because already in question number 2, we covered this. So check that where this is coming. Budgeted sale plus closing stock minus opening stock. Where this is coming. So this is budgeted sales plus closing stock minus opening stock. B. In B it is coming. So sales minus opening stock plus closing stock. So answer is B here. Clear? So this is B. So refer question number 1, second solution. Already I mentioned. Yes, sir. Chaliye, now 1A completed. 1A completed. I hope all students understand this. Yes, sir. So in 1A, B question is easy. Okay. Means question number 2 is easy. Question number 3 also easy. Question number 4 also easy. Question number 5 also easy. Only first question, some twist is given. Students have to concentrate on 3 months, 9 months data. But remaining 4 questions are easy, manageable. So I hope students have correctly done that. Okay, now we'll move for the B part. Question number 1B. Yes, sir. So question number 1B. This is match the following. This is what? Match the following. So every time institute is giving 4 left hand side, 4 right hand side combinations. In some papers they have given 6 also. But this time they have given right hand side more options, so that the student cannot match the things on without conceptual knowledge. If they try to do that, mistake will come. So it is a good approach actually. So from this, only a deserving candidate will get the marks, and that should be correct also. Tell you, sir. So variance analysis. In standard costing, in our regular classes, first point which I share with the student is what? Standard costing is a costing technique in which actual cost, standard cost will be analyzed, means, and this is done by the managerial level people. So standards will not set by generally means less qualified people or less experienced people. So this is done by the expert people. So here management is involved. So this is management by exception. This is what? Management by exception. So I hope our students have clearly understand this and they have chosen the correct answer. So first correct match following is C. Second, zero-based budgeting. Zero-based budgeting means a new organization or first time you are preparing the budget, so don't have any base. A budgeting compulsory base required, previous data required. So without previous data, if you are preparing the budget, means you are starting from zero, scratch. That is called as what? Zero-based budgeting. So this is nothing but what? Planning. This is nothing but what? Planning. Okay. And decision making. This is nothing but planning and decision making, means futuristic decision. This is on the basis of zero base. So the options which are given in the question, according to that, this is the correct answer. Okay. So for second question, correct match is H. Now angle of incidence, already this is covered in your question number 5 of 1A. Key low angle of incidence, low profitability. Larger angle of incidence, high profitability. So this is a representation of profitability rate. So already it is given in the question. Profitability rate. Yes, sir. So this is E. Now key factor is what? Whenever availability is less, requirement is more. In organization, resources are limited. That is called as key factor. So in marginal costing, we understand this. Yes, sir. Decision making. Whenever there is a shortage of resources, optimum utilization is required. So limits the activity of an entity. So for fourth, correct match is F. That's it. Very simple question. Yes, sir. So first, variance analysis, management by exception, C. Zero-based budgeting, decision package, H. Angle of incidence, profitability rate, key factor, limits the activity of an entity, F. So C, H, E, F is your correct answer. Yes, sir. I hope students have correctly picked the answers, especially our students who are attending the classes and always try to learn the subject in conceptual way. I hope this was very simple question, except zero-based budgeting part. Zero-based budgeting is also I covered, not an issue. But remaining 3, any student can attempt easily. And one is free question here. That is angle of incidence, already clear. It is tested in 5th question of 1A. So now we'll move for the next question. Yes, sir. This is true, false. So in this 3 questions are easy. One question is generally not a difficult new question. That's it. So 1B is also very easy. One question is difficult. That's it. Like 1A, one question is new question, remaining easy. Here also one question is new, remaining 3 very easy. Now next is 1C. 1C. Yes, sir, 1C. So here only we have to write true, false. Reasoning is not required because this is a 1-mark question. So we are not interested to write any reasoning here. But I will explain the reasoning also. So this is on standard costing. So in standard costing, we learn material variances, labor variances. So in that we will understand what is standard quantity, what is actual quantity, what is standard rate, actual rate, standard price, actual price, what is standard hour. All this we'll discuss now. Yes, sir. So this question is on hour, standard hour. Okay. So standard hour is the quantity of output or amount which should be produced in 1 hour under given condition. No. So standard hour is the labor time. This should not be quantity. This should be labor time. Labor time which will be allowed to the labor. Standard hour is the labor time which is allowed to the labor for producing certain number of units in 1 hour. So this is not the quantity, this is the labor time. So answer is not correct, this is false. This is false. Okay. So here false. The standard hour is time allowed. This is not related to quantity. Okay. This is false. Now second question. Clear? Now performance based budgeting is a technique under which responsibility centers are established and targets in terms of physical performance are set for each response. The responsibility accounting, this is a question on your group 1. In group 1 we understand basic cost concepts. In that profit center, investment center, cost center, these are part of responsibility accounting. So this will be done with one specific objective, that is decentralization. If functions are decentralized, then functions will be executed in systematic way and workload will be shifted from one person to different persons. So it will be easy for organization to control the activities and to achieve the target. So here also same is tested. The responsibility centers are established and targets in terms of physical performance are set. So this is true. Because here decentralization is taking place. Now fixed cost per unit varies with change in volume of production, but variable cost per unit remain fixed. Okay. So fixed cost will change. If volume is more, fixed cost will be less. If volume is less, fixed cost will be more, but variable cost per unit always change. This is the assumption of your CVP analysis. When we start CVP analysis topic, first we will discuss this only. Without this, you cannot understand CVP. So in our regular classes, I especially highlighted this. In basic concepts also, in group 1 we discuss this. In group 2 also, when we start CVP analysis, marginal costing, we discuss this. So this is very simple question, gift question. So this is true. Now next point. If break-even point is high, angle of incident is small. This is a question which is already covered in 1.5. Question number 1A 5. So if break-even point is high, angle of incidence is small and margin of safety is low, then business will start making profit at a higher rate. No. If angle of incident is small, profitability will be low. If angle of incidence is high, profitability will be high. Similarly, margin of safety low means profitability will be higher. No, low profitability. So they are asking the question on high rate. So angle of incident small means high rate is possible? No. So this is false. Very simple. This is also simple question. So in this, 3 questions are simple. Again, 1 question is new question. This is a new question. Remaining 3 very easy. That's it. So I hope except 3 questions, first section is manageable, very easy. So you can score sufficient marks here. So in my opinion, out of these 6 questions, 5 questions are easy. 5 questions are easy manageables. Next, out of this, all answers are easy out of 4 out of 4. In this, 3 are easy. So it means 5 plus 4 plus 3. It means 12 marks you can easily score here. So 12 marks, very simple. 12 marks, very simple. Okay. So only 2-3 questions are new here. That's it. Okay, so 12 mark gifted marks. So this section 2, I will prepare the separate video for this because it will take time. Means already I solved the question, but today your last paper group 2, so don't watch this. After your classes, your exam only should watch this. So in part 2 video, all this already I solved. FM also I solved, costing also I solved. So 100% correct answers. You should not wait for institute suggested answer. This is 100% correct. Okay, so after institute is releasing the suggested answer, you can check. This is 100% authentic, genuine answers. Okay. In one small area, if institute assumption is different, it may differ. But MCQ questions, 100% authentic answer is there. So for section 2, long answer questions, should wait for the second video. Please subscribe and like, so we can prepare the more number of videos on your suggested answers, new innovative techniques, okay, how to solve the questions in simplified way, which sources of materials we have to learn, so that even you can crack the difficult examinations also. Like in our classes, we manage properly this from past 2 years, because I understand that after COVID, institute will test challenging papers only. Reason is demand supply situation, and course demand is increasing. CMA course demand is increasing day by day. In job side especially, very good package is coming. So demand increasing means definitely papers will not be very simple concept based paper. Okay. Yes sir. So descriptive questions solutions we'll discuss in the next video. So wait till that. We'll discuss about the FM MCQs, fill in the blanks, true false, match the following. Fill in the blanks generally not given, MCQ only given, match the following given, and true false given. So let now we'll start the FM part. Okay, right sir. So in next video I will prepare the answers for long answers. Now this is part B, financial management. I hope fast. I have not used very fast way of explaining the things. I taken reasonable time to explain all the points clearly. I hope part A, section 1 is clearly understand to all students. Only 2 questions are new questions. The rest of the questions are manageable, not very difficult. Students should learn the subject conceptually. Costing subject, FM subject, concept compulsory. Yes sir. So without wasting time, now we'll start FM. Right sir. So this question is on capital budgeting. This question is on capital budgeting. This question is exactly similar to your December 22 examination. In December 22 examination, if you see capital budgeting investment decision question, in that they have given one specific question on reverse working. It means by using some algebraic or max, we have to calculate the required things. So this question is similar to that. Check December 22 paper, similar question is given. Now in this question, they have given annual cost saving, applicable present value of annualized cash flow 2.855, profitability index 1.064, always 0. Now we have to find out NPV. See, this answer can be solved in 2 different ways. This answer can be solved in 2 different ways, because 100% data is not given here. Some assumptions are required here to solve this question. So first assumption is this 2.855, this is present value of annuity interest factor. This is present value of annuity interest factor. So whenever we discuss about present value of annuity interest factor, this will be for a particular rate and time period. Okay, so here rate is also not given, time period is also not given. So generally this 2.855 present value of annuity interest factor will come at what percentage? Percentage is not very much important here. This is an annuity value, that's it. This is an annuity value. Okay, this is what? Annuity value. So when cash inflows are same, we use this. When cash inflows are uneven, different, we use present value of interest factor. So difference between annuity, interest factor, you know. Annuity factor will be used when cash inflows are same. Interest factor will be used when cash inflows are uneven or different. That's it. Now we have to calculate NPV. So NPV is what? Discounted cash inflows minus discounted cash outflows. Total of discounted cash inflows minus total of discounted cash outflows. So discounted cash inflows minus discounted cash outflows is NPV. Yes sir. You know this? Yes sir. So we have to calculate discounted cash inflow and discounted cash outflow to find NPV. In question they have given annual cost saving. So if you multiply this 2.855 with annual cost saving, now you can get inflow. But in this question we are not assuming this one as inflow. Reason is similar question is already given in December attempt also. In that they have taken this for calculating the outflow. So according to that assumption I am solving this. So first I will calculate outflow. So this outflow is 80,000 into 2.855. So discounted outflow. Okay. So 80,000 into 2.855. So this will be 2,28,400. 2,28,400. This is your outflow. This is what? Outflow. This one. Now profitability index. Profitability index means what? Inflow by outflow. In short I am writing inflow by outflow. So profitability index is 1.064. Inflow is how much? We don't know. Outflow is 228,400. So inflow will be how much? 228,400 into 1.064. So 2 lakh. So 228,400 into 1.064. So 2 lakh 43,017.6. This is your inflow. Now inflow minus outflow. So inflow is 243,017.6 minus outflow 228,400. Subtract this. So 14,617.6. So first answer A. A is correct answer here. Now this can be solved in different way also. Suppose if you are assuming 80,000 into 2.855 as inflow, then none will come answer. Which answer will come? None. But I am not using second option here because same question is tested in previous examination. So I am expecting ki institute will give the A answer only in suggested answer. Okay? Because this, if students have solved this type of question, they will solve according to this methodology only. If any student who is not having idea, they will fail. In our academy, this is covered and our students will know. And I am expecting other students, other academies also covered this. Any student who is learning conceptually, they will follow this and they will solve this question in correct way. Okay? Yes sir, understand sir. So perfect answer 14,617.6, answer A. Now check. Financial management, section B and section 3, solution to question number 6A. So profitability index is what? Discounted cash inflow by discounted outflow. So this is 1.064 equals to PV of inflow by outflow. So outflow is 228,400 coming, this total. 228,400. So 228,400 into 1.064. So inflow is coming 243,017.6. So NPV will be 14,617.6. If you take different assumption, if you shift this to numerator, because mostly annual savings into annuity factor will give the inflow also. So answer none will come. But I am not following that because same question is available in the previous exam paper also. So according to that we solve this. So answer is A. Right sir. I hope all students understand this. So answer is A. Yes sir, understand sir. Now question number 2. Actually this question is not fair. In my opinion, this question is not fair. Reason is marks point of view. Here institute is giving how many marks? 1 marks. 1 mark. And this question is not suitable for 1 mark because we have to do lot of workings in this question. This is a 6 mark question. Institute tested in 1 mark. So this side I am not happy with the institute approach. So this is actually not deserving for 1 mark. At least this should be given for 4 marks or 6 marks question. Okay, anyhow given, so we have to discuss the answer. This is on Modigliani and Miller, capital structure, tax model. This question is on Modigliani and Miller, capital structure, tax model. In Modigliani and Miller we have 2 models, without taxes, with taxes. Yes sir. This is on tax model. Yes, sir. So first, what is the given data? Check. So X and Y, two companies are there. So whenever Modigliani-Miller model is given, compulsory one company will be levered company, another company will be unlevered company. A levered company means the company in which debentures are there. Unlevered company means the company in which no debentures are there. So we have to calculate the value of levered company also, unlevered company also. So first we will calculate value of unlevered firm. Okay, and thereafter in that we will add tax benefit of debenture. So it will be giving you value of levered firm. This we understand in our regular classes. Yes, sir. So value of unlevered firm plus tax benefit on debentures, you will get value of levered firm. So this you have to calculate first. So 10% debentures are there in Y Limited, 4 lakh rupees. EBIT 2,40,000 given, equity capitalization rate 20%, tax rate 25%. Assuming that all assumptions of model are met, which of the following is false? False we have to pick here, not true. So if you want to pick false, you have to check this is correct or wrong, this is correct or wrong, this is correct or wrong. It means I have to check all this calculation. That's why this is not perfectly suitable for 1 mark. Yes, sir. Now concentrate. So value of firm X and Y according to hypothesis. So value of unlevered firm is what? EBIT into 1 minus tax rate divided by cost of equity. Very simple, net income by cost of equity. So net income is EBIT into 1 minus tax rate by 20%. So 9 lakhs. Now value of levered firm is what? Unlevered firm plus tax benefit. So unlevered firm 9 lakh plus tax benefit is how much? 4 lakh rupees debenture. Tax percentage 25. So tax benefit 4 lakhs into 25%. So 1 lakh. So 9 lakh plus 1 lakh. 10 lakh is the value of levered firm. So 9 lakh unlevered, levered 10 lakhs. So first answer is correct here. So this is not a false answer. This is a correct answer. Because 9 lakh X value, 10 lakh Y value. So this is correct. Now we have to calculate KE of Y. KE of Y. Okay. So market value of debenture is considered as what? In capital structure D. Market value of equity is considered as what? S. Okay. So S is equal to what? Total value minus debenture. Total value minus debenture. So total value is how much here? 10 lakh. And debenture how much? 4 lakh. Clear? Out of total 10 lakh rupees value, 4 lakh is debenture. So equity how much? 6 lakhs. Equity how much? 6 lakhs. Now we have to calculate net income here. You have to calculate net income here. Net income is what? Earning before interest and tax minus interest minus tax. Earning before interest and tax minus interest minus tax. So first we deducted the interest 40,000 rupees on debentures. That is 4 lakhs into 10%. Then 1 minus tax rate. So 1,50,000 is coming earning after tax. This will be divided by equity. Because earning after tax by equity is equity capitalization rate. Equity capitalization rate is 25% coming. So this is also correct. Yes, sir. This is also not false. Now next is what? Overall cost of capital we have to calculate. What we have to calculate? Overall cost of capital. Overall cost of capital is nothing but WACC. Cost of equity into weight of equity. Cost of debenture into weight of debenture. This is WACC. For both we have to calculate this. Yes, sir. WACC. So K of levered firm, value of equity by total value into cost of equity. This is weight. This is what? Weight. This is what? Weight. Weight of equity. This is weight of debenture. Understand? Weight of equity, weight of debenture. Yes, sir. Understand, sir. So weight of equity into cost of equity, weight of debenture into cost of debenture. Always remember cost of debenture tax rate given. So it should be post-tax. So tax rate is given. Please remember. So post-tax required. If you apply pre-tax, it will be wrong. Because on debenture, there is always a tax benefit. Okay, now? Yes, sir. So 10% is the cost of debenture. So from this, if you subtract tax 25%, so 7.5% is the post-tax debenture. So weights will be 60%, 40% now, because total value of and means levered firm is how much? 10 lakhs. Okay. So 60% is equity, 40% is debenture. Okay. Accordingly, 60 into 0.25, 40 into 0.075. So 15 plus 3, 18% coming. Now, unlevered firm. Unlevered firm, there is no debenture now. So cost of equity will be equals to overall cost of capital. In unlevered firm, there is no debenture. So cost of equity, overall cost of capital will remain same. So 18%, 20%. So this is also correct. So this answer is none. False answer is what? None. Because all are true. So D, none. So answer is D. I hope this is understand. Yes, sir. Question is not very difficult, but it is not suitable for 1 mark. It should be for 6 marks. So any student who is perfect in this, in fast way he can do this, then only he should attempt an examination. Otherwise, skipping this question is best in my opinion, because it will consume time. Yes, sir. Chaliye, so this is also clear? Yes, sir, very much clear. Now, question number 3. This is on cost of capital Gordon model. Cost of capital Gordon model. So you know there are different models used in calculating the cost of equity. Okay, earnings, dividend plus growth, CAPM. Most frequently used models are dividend plus growth, Gordon model, and CAPM model. So institute has tested the question on Gordon's model. So in Gordon model, you know the formula D1 by P0 plus G. This is cost of equity. Cost of equity is what? D1 by P0 plus G. So D1 means what? Current dividend into 1 plus growth rate. Current dividend into 1 plus growth rate. Now P0 means what? Market price per share. Market price per share. So this is 44 given. Okay. And growth rate is missing. This we have to calculate. D0 given in the question. This is 4. This is 4. And along with this, cost of equity we have to calculate here. So how to calculate cost of equity? They have given WACC. They have given WACC. WACC given, no? Yes. Weighted average cost of capital. So weighted average cost of capital, what items will come in this? Cost of equity will come. Okay. Into weight of equity plus cost of preference share into weight of preference share and cost of debenture into weight of debenture. From this formula we have to calculate. So if you substitute the values here, you will get cost of equity, because weight already given, this is given, this is given, this is given, this is given, and this is given. So this is missing here. KE is missing. So from this equation, we can calculate the KE. I hope you understand this. From this equation, we can calculate the KE. See that? So weighted average cost of capital is 15.44. So cost of preference share 15, cost of debenture post tax. See, the tax benefit will come in debentures only. So here you should do post tax. So post tax already given 7.2. 7.2. So WACC formula is what? Cost of equity into weight of equity, cost of debenture into weight of debenture, cost of preference share into weight of preference share. This is 15.44. Now out of entire capital structure, weight of equity 40%, weight of debenture is 20%, weight of preference share is 40%. So 40, 20, 40. This is the combination of capital structure. Now accordingly, cost of equity we don't know. So 0.4 into KE, 0.4 KE, 7.10 into 0.2 and 15 into 0.4. This total will be 7.44. These two items total is 7.44. Now by solving this, KE 20% coming. How much coming? 20%. Now we have to substitute in the Gordon model formula. To substitute in the Gordon model formula. So KE as per Gordon's model, D1 by P0 plus G or D1 by K minus G is P0 formula. But D1 is what? D0 into 1 plus G. So D1 is equal to 4 into 1 plus G. So we are substituting in this formula because we have to calculate what? Growth rate. So I am substituting in this formula. Right, sir. So P0 is equal to D1 by K minus G. So 4 into 44 is equal to 4 into 1 plus G divided by 0.2 minus G. Okay. So 4 into 1 plus G is equal to 44 into 0.2, 8.8, 44 into G minus 44G. So after solving this, 48G is equal to 4.8 coming. So G equals to 10% coming. That's it. So answer is C. Answer is C. C answer. C is the correct answer. This is also manageable question. But in 1 mark, this is not justifiable. In 1 mark, this is not justifiable. At least this should be for 4 mark, 5 marks, or 2 marks at least, minimum to minimum. Now this is also 1 mark. It is not a deserving question. This is on receivable management. This is on receivable management. Some tricky question is there and time consuming question. And the stuff which is covered, likely to cover in this question is time consuming question. Okay. So this is also not deserving for 1 mark. So please, I request the institute council members, next time please take the care about this. Time management is also very important, sir. It is my humble request, please concentrate on this area, because the students will study throughout the year for their career building. So if time management is not possible for them, they will struggle, na sir. So it's my humble request, please next time take the proper action and reasonable steps. The question should be at least manageable. Tough paper, easy paper, okay. This is a professional course. Compulsory tough, easy is part and parcel of course. But time management is actually important, na sir. So FM questions are very time consuming questions in this paper. It's my request key, they should concentrate on this area. Okay, if they are listening or watching this, otherwise I can't do anything because institute is supreme power. So total sale 125 lakhs, credit sale 4 times of cash sale, variable cost 85%. So this is on receivable management. Bad debts 5%, selling price 500, average cost 450, credit terms 3 by 24, net 40, 25% of credit customers avail cash facility. Okay, and here required rate of return is 16% pre-tax, tax rate is 25%. Calculate opportunity cost of investments in receivable. Means investments in receivable we have to calculate here. So always remember, investments on receivable is calculated from cost approach. Now previously we follow this in traditionally on sales, but now concept is changed. We have to calculate this on cost. Clear? Yes sir. Let's start. So first we have to calculate number of units. So total sales 1 crore 25 lakhs given and selling price 500 rupees given. So this is 25,000 units. Clear? Actually this is a lengthy question, that's why I am using this way of explaining the things. So 25,000 units are there. This is your number of units sold. Now we have to calculate cost of sale. Average cost per unit into units sold. So this is average cost per unit is 450 into 25,000. So 1 crore 12 lakh 50,000. This is cost of sale. Now total cost of credit sale. Total cost of credit sale. So total cost of credit sale is what? Total cost of credit sale. See, 4 times of cash sale is given. 4 times of cash sale. It means if your total sale is 5, credit sale will be 4 by 5. Credit sale will be 4 by 5. So this is 80%. This is 80%. It means you cannot calculate on total sale. Receivable management is applicable on credit sale only. Receivable management is applicable on credit sale only. Please remember. If you calculate on 1 crore 25 lakh, it will be wrong. You have to calculate on credit sales portion only. From credit sales only we have to calculate this. So credit sale portion is 4/5. So because of that, this is 80% coming. So this we have 1 crore 20 lakh 50,000. So 80% is credit portion. This is 90 lakh. That's it. After this, you have to calculate the average collection period. Here average collection period is not directly given. This is also one of the challenge here. Average collection period is not directly given in the question. Because some customers are opting cash option, some customers are opting non-cash option. See, 25% customers are availing cash option. So remaining 75 customers are not opting cash option. It means the 25% customers who are opting the cash option, they will pay the amount in 24 days. Total 40 days time given, but they will pay the amount in 24 days. See here. They will pay the amount in 24 days, 25% customer. So remaining customers are not opting now, they will pay in 40 days. So 24 days into 25%, 40 days into 75%. Yes, sir, this is the speed breaker in this question. Here if you make mistake, answer is wrong. So 36 days coming, that's it. Now 90 lakhs into 36 by 360 into your required rate of return is 16%. So this is pre-tax. So we have to calculate post-tax. So 16 into 1 minus tax rate into 75%. This is 12 coming. So 16 into 1 minus tax rate, 25%. So post-tax rate is 12%. So we have to use 12%. So 1,08,000 coming. So answer is A. I hope this is understand, sir. Yes, sir. Okay, now? Yes, sir, understand. See, whenever you calculate the cost, we will consider variable cost also, fixed cost also. Directly here they have given average cost per unit. So directly should multiply with average cost. Okay? Don't calculate on variable cost. If you calculate on variable cost, you are not considering this one. That's why we calculated from average cost. So 1,08,000, A answer is correct. A answer is correct. I hope this is also perfectly understand to students. Yes, sir. Now question number 5. This is also, I can't say anything because words are not coming. Horrible question. Miller or model is first of all practical question. If they are testing means here student should have log calculation knowledge or calculator technique. Without calculator technique he cannot solve this question. Okay, and this is lengthy question also. Again, this is not deserving for 1 mark. Chaliye, so anyhow given, so we have to discuss the answer. The company maintains a minimum cash balance of 10 lakh. The standard deviation of company daily cash flow 3,60,000. The annual interest rate is 12%. Transaction cost is 180. Assume 360 days. Which of the following is false? Again, we have to check false here. So Miller or cash model, Baumol model. You have 2 models in cash management. So Baumol model is when cash is even requirement, and Miller or model is used when cash is uneven requirement. Uneven requirement means we use Miller or model. If regular requirement is same, even we use Baumol model. So this is on Miller model. So here generally upper limit, okay, lower limit, control point, these discussions will take place. So any student who is having the knowledge about this, they can solve. Otherwise, they cannot understand this. Okay. So we'll start this one. So according to Miller or cash model, Z. Okay. Control point. Z is called as what? Control point. So control point, how to calculate? 3 by 4 into, this is what? Your transaction cost. Okay. So 3 by 4 into transaction cost into 3,60,000. 3,60,000 is what? Your daily cash, standard deviation of daily cash flow. Yes, sir. Standard deviation of daily cash flow. Into 2 divided by what is your interest rate? 12%. And number of days? 360. So 0.12 by 360, 1 by 3. Clear? So here you need to use a log table or generally calculator technique. Okay. So For this, if you want to know how to calculate this, you have to watch the next video, or in our regular classes this will be explained. So 17,57,500. Actually in Miller and Orr model, practical question is not justifiable because it is a time consuming question. So most of the student will skip this, and this question is lengthy also. But I am preparing the video for solutions, so it is responsibility of me to solve all the questions. So according to this calculation, Z is coming 17,57,500. This is calculation. The formula is what? 3/4 into transaction cost into standard deviation of the cash flow into 2 divided by interest rate by number of days. Okay, and power 1/3. Clear? Upper limit is what? Lower limit plus 3Z. So lower limit is already given here, minimum cash balance 10 lakh plus 3Z. 3 is the formula, Z is already calculated. So accordingly 62,72,500 coming. Return point, lower limit plus Z. So 10 lakh plus 17,57,500. So 27,57,500. Average cash balance is what? Lower limit plus 4/3. This is not 3/4. This is 4/3 into Z. So 10 lakhs plus 4/3 into 17,57,500. 33, 43, 333 coming. So no answer is matching here. So average cash balance is not matching here. So no answer is matching here from the calculation. See, average is also not matching. This is also not matching. This is also not matching. So answer is none here. Answer is none here. Okay. So this is unexpected question examination point of view, because previous question paper Miller Orr model is not tested. So this is totally an unexpected question, and this is not suitable for 1 mark. At least this should be tested for 5 to 6 marks. I hope this is also clear. That's it. Okay, now question number 6. Which among the following is not an assumption? Again, there is a problem here. Not assumption of net income approach. So no taxes. This is the assumption in net income. No change in risk perception. This is assumption in value of firm does not remain same. This is also assumption. Because optimal capital structure will increase the value of firm. Non-optimal capital structure will not increase the value of firm. So answer will be C ultimately. Debt capitalization rate is equal to equity. No, this will be different. This will be different. Debt rate will be different. Equity rate will be different. So this is not an assumption. So answer is C. So answer is C, because cost of debenture is less than cost of equity. Always you know, equity shareholders will have more risk, so their cost will high. Debenture holder will have less risk, so their cost will be less. So cost of equity is always higher than cost of debentures. Now first section is over. So from FM, I am not satisfied from the student institute point of view, except question number 6A and first question and third question. First question, third question and fourth question. Remaining questions are time consuming, especially question number 2 time consuming, question number 4 time consuming, and question number 5 time consuming. Okay. So now B, 6B. Now Miller Orr cash model. Already I told you the Miller Orr cash model is used for uncertain cash flow, uneven cash flow. So Miller Orr, so uncertain demand. So this is B. So first answer matching point is B. Retained earnings, annualized equivalent present value, optimal capital structure. See, first annualized equivalent present value. This will be used when life is uneven. When life is uneven. So directly I am explaining third point first. Uneven life. F. Third answer is F. F is matchable point. Now, optimal capital structure. Optimal capital structure theory. Net income approach, net operating income approach, traditional approach, Modigliani-Miller approach. These are the different approaches now. So net income approach, net operating income approach, this will be advocated by David Durand. David Durand. Traditional approach is advocated by Solomon Ezra and Modigliani Miller, already Modigliani Miller. You have to remember names also sometime. Optimal capital structure, answer is Durand. Answer is what? Durand. So G. Now second is very easy, that's why I postponed this explanation. Retained earnings is always the earnings available with the company on which they will not pay any actual cost. They can use this earnings for their reinvestment purpose in future. So this we will discuss in our dividend policy chapter also. This we will discuss in our cost of capital topic also. Key on retained earnings, actually we will not pay the cost, but in financial management, for every source of fund, there is a cost, either explicit or implicit. So retained earning is a implicit cost. Retained earning is a implicit cost. So answer is D. So second answer is what? D. This is not explicit cost. Explicit means you have to pay to outsider. Implicit means it is internal. So on retained earnings, there is no outside cost will come. This is internal. Here some people who are expecting ki Walter model. No, Walter model generally dividend is used. You will use dividend. In Walter formula, what is used? Dividend. Retained earnings are not used. Okay. That's why I am not expecting Walter is the answer. This is the correct answer in my opinion. Clear? So this is the BDFG. You are match the following. So B, D, F, G. I hope this is also clear. This is simple question, manageable question. Here I am happy with the institute key. They have given simple question. Yes, sir. Till now, true, false. Last section of your small answers. True, false. So in case of a partially debt finance company, KOE is less than KE. Yes. Means because of debentures, sometime we will get the benefit. Always, but in some time we'll get more benefit. Students will think that key cost of equity is always a yes. But because of debenture, sometime what will happen? Your overall cost of capital will be less than individual cost of equity. That is possible. So, partially debt finance firm. Partially debt finance firm means, partially means it can be 50-30, means 50. It can be 80-20. Any combination. Debenture is there in the capital structure. So, because of debenture, sometime there is a possibility that your overall cost of capital will be less than cost of equity. Your overall cost of capital can be cost of equity. How it is possible, sir? Suppose cost of debenture is 8%. And weight of debenture is suppose 50%. And cost of equity suppose 20%. And weight of equity 50. So this is 4, this is 10. So 14. This is what? Overall cost of capital, KO. But here equity is how much? 20. So overall cost of capital is 14 coming, but equity is how much? 20. So this is true. This is true. Yes, sir. Now every source of funds has explicit cost of capital. No. Means in retained earnings there is no explicit cost, only implicit cost. You have to make the payment to debenture holder, preference shareholder, if preference share is liability, or borrowers, means the funds we have taken for long term purpose. Okay. So retained earnings we will not pay any cost. That's why this is not a correct statement. Because every source he mentioned. So retained earning is also one of the source now. So retained earnings, if you are taking retained earning is also one of the source, this is not correct statement. So this we have to write false. Because retained earnings will have implicit cost. Already in match the following this is tested. Yes, sir. Next, if profitability index of project is less than 1, its NPV will be negative and IRR will be greater than discount rate. Yes. Check this question once again. If profitability index of the project is less than 1. Yes. If profitability index is less than 1, Outflow will be more, inflow will be less. So NPV will be negative, yes. And IRR will be greater than discount rate, yes. So this is true. Average cash balance under Miller or cash model, lower plus 3 by 4. No, this is 4 by 3. This is 4 by 3. Okay. This is 4 by 3. So this is not correct. This is false. That's it. So true, false, true, false. This is your answer to 6C. So with this, our session is completing now. For long answer questions, I will make the separate video. But the students who are watching this, they have to subscribe and they have to like. So we'll prepare the more videos, and it will be for especially CMA students. I will prepare the conceptual videos also, because I'm the faculty from past 18 years. So for the benefit of CMA students, I will prepare the conceptual videos without taking much time in difficult topics also. So in next examination, students will be benefiting from that, so that they can crack the exam with good marks. Okay, if you have any queries, if you have any doubts, please, only you have to send the WhatsApp message here, because we cannot leave the call. This is my number. So on this, you have to send the messages if you have any doubt, queries on this. Otherwise, you should contact to our academy. Our academy is having 3-4 phone numbers, so you can contact the academy. They will assist you. If you have subject related doubts, then you can WhatsApp. In my free time, I will check the questions and I will answer. It will take 1 day also, 2 days also, depends on my schedule. This is my number. Only you should WhatsApp, don't call. This is WhatsApp number only. Okay. So I hope all students will like this video, and definitely they will appreciate this. Okay. So if you are appreciating, so please subscribe and like this. So I will prepare the next video also. So already I prepared the answers for costing, long answers also, and financial management, long answers also. So after your examination, because today may be last examination of group 2, I will upload. Clear? So within 1 or 2 days, I will definitely upload, or by tomorrow or day after tomorrow I will upload. So I hope students will like this. So please subscribe and share. So good day, and I will pray the maximum number of students should succeed, and especially deserving students should succeed. So with this, I am closing the session now. Good day.